Hello and welcome to More Coin Bureau. My name is Guy and I think I'm going to let Lewis take this one. Lewis, they're all yours.
Thanks, Guy. Okay, let's get started. Ever since MicroStrategy first added Bitcoin to its reserves in 2020, investors have speculated about which companies would follow suit. Over time, more firms have indeed jumped on board, and recently, there's been a flurry of firms stacking sats. This has propelled BTC to new all-time highs, while the broader crypto market lags behind. But what happens to these companies during a bear market? And more importantly, what damage could this do to Bitcoin's price? Today, we find out. My name's Lewis, and you're watching the Coin Bureau. Before we begin, you need to know that I'm not a financial advisor, and nothing in this video should be considered financial or investment advice. This video is purely for entertainment and educational purposes only. So, back in August 2020, Michael Saylor, the then CEO of MicroStrategy, now simply called Strategy, made the decision to buy $250 million worth of BTC, despite the company having nothing to do with crypto. The reason for this could be boiled down to one word: inflation. Saylor was well aware that the value of his firm's treasury was being eroded, and realized that Bitcoin is a solution to this. Ever since then, Saylor has arguably become Bitcoin's most bullish advocate, and Strategy has regularly added ungodly amounts of Bitcoin to its reserves. At the time of shooting, Strategy holds 597,325 Bitcoin, valued at over $64 billion. That is 3% of Bitcoin's circulating supply. And there's a good chance that by the time you watch this, Strategy's bags will have exceeded 600,000 Bitcoin. That is pretty crazy. Notably, this has done wonders for Strategy's MSTR stock. In the 5 years since it adopted BTC, MSTR has rallied over 3,200%. It's no surprise then that many other companies have wanted to replicate this strategy for themselves. If you watched our video about the companies going all in on Bitcoin, you'll know many companies have taken a double dose of the orange pill and asked for seconds. These include Bitcoin miners like Mara Holdings and Riot Platforms, Japanese MicroStrategy clone MetaPlanet, healthcare firm Semler Scientific, and Chinese car and finance company Cango Inc. Well, since that video was released just a few months ago, the number of companies adding Bitcoin to the reserves has significantly increased. What's crazy is that some companies that are newer to the game have quickly become some of the largest crypto corporate Bitcoin holders. At the time of filming, Mara Holdings holds second place behind Strategy with just under 50,000 BTC. But in third place now is 21, which has jumped above previous third place occupant Riot Platforms. 21 already holds over 37,000 BTC, while Riot holds over 19,000. Notably, 21 has only been stacking sats since May of 2025. The fifth largest publicly traded holder of Bitcoin is MetaPlanet, which has seriously ramped up its accumulation of the digital gold in recent weeks. The company now owns more than 13,000 BTC, although they've recently made multiple purchases just days apart, so it's likely that by the time you watch this, they will have even more. And more recently, there's also been a wave of companies creating or considering a Bitcoin treasury for the very first time. For example, K33, a leading crypto research firm, began accumulating Bitcoin in June. Swedish healthcare company H100 Group started in May, and Anthony Pompliano's ProCap began in June, with the latter already holding nearly 5,000 BTC. Meanwhile, eyeing up a Bitcoin reserve for the first time is K-Wave Media, which plans to raise $500 million to become Korea's first company with a Bitcoin treasury. Elsewhere, Nasdaq-listed fintech firm Mercurity aims to raise $800 million for its own Bitcoin reserve, while semiconductor firm Sequans Communications seeks over $380 million for BTC. And this trend isn't slowing down, nor is it limited to public traded companies. At the time of shooting, there are 141 public companies holding almost 850,000 BTC, and another 42 private companies holding over 290,000 Bitcoin. So that's 183 companies, and counting, holding well over 1.1 million Bitcoin. roughly 5.7% of the circulating supply. Oh, and by the way, if you're enjoying the video so far, show those like and subscribe buttons some love, and be sure to hit that notification bell too so that you don't miss our next one. And if you want to scoop up some Bitcoin of your own, or any other crypto for that matter, then you have to check out the Coin Bureau deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best crypto exchanges. These deals won't be around forever, so take advantage of them while you still can using the link in the description below or the QR code on the screen. Now, you may be wondering how so many companies have been able to jump on the bandwagon and start scooping up Bitcoin by the bucket load, especially considering that one BTC currently costs over $100,000 and probably more when purchased OTC. Well, to understand this, we first need to go back to Saylor's company and understand strategy. In essence, Strategy is able to fund its BTC hoarding through 3 avenues: convertible debt, stock issuance, and its operating cash flow. The latter is pretty self-explanatory, but the others do require a little explaining. So let's start with convertible debt. The way it works is this. First, investors give Strategy cash. In return, they get a certain amount of bonds that pay them very low interest rates. The reason it's called convertible debt is because if the price of Strategy goes up, the people who loan the money could convert those bonds into shares of MSTR, cashing in big. And if the price of the stock goes down, then they will simply keep receiving small amounts of interest until the maturity date. This is great for Strategy because it allows them to collect billions of dollars up front. And they also don't have to immediately dilute existing shareholders' ownership because no new shares are issued unless the owners convert. And this is great for investors because they essentially are investing with no risk and can still capture the potential upside if Strategy stock goes up. And so far, it has been working out extremely well, doing even better than buying and holding Bitcoin itself. As for the issuance of stocks, this is done through an at-the-market or ATM program. Essentially, ATM equity programs allow companies to raise money by selling new shares on the open market. ATMs differ from traditional offerings because, unlike traditional offerings, ATMs are not tied down to a schedule, meaning Strategy can issue stock whenever it sees fit. So then, naturally, this begs the question of whether other companies are using the exact same strategy to build their own Bitcoin treasuries. The answer, it's a bit of a mixed bag. Although most companies are using similar methods, there are some differences. For example, Mara Holdings and Riot Platforms are Bitcoin mining companies, so they will accumulate BTC through their day-to-day operations. However, they've also accumulated Strategy's approach by adding more to their stash through convertible corporate bond offerings. Mara has also issued stock through an ATM program, and in July of last year, it did adopt a full HODL approach. Basically, this involves keeping 100% of its mined BTC. We should note that according to Bitcoin Treasuries, Mara did sell 100 Bitcoin in May of this year, but honestly, that is really nothing compared to the almost 30,000 Bitcoin that they've gained since adopting this approach last July. Meanwhile, another company stacking Bitcoin is Metaplanet, which was once dubbed as the MicroStrategy of Asia. Originally a hotel real estate firm, it nearly went under during the pandemic. The company then shifted to Bitcoin, selling all but one hotel, which was then renamed the Bitcoin Hotel. And honestly, who wouldn't want to stay there? Naturally, the cash raised from the sales of these hotels is being used to fund Metaplanet's purchases of BTC. On top of this, the company is also raising cash exclusively earmarked for Bitcoin, including the issuance of zero-interest and low-interest bonds, also sales of equity, and through refinancing its existing debt. By now, you've probably noticed a pattern. The key similarity between almost every company building a Bitcoin treasury is that they usually issue stocks and convertible debt. But why would investors even buy this debt in the first place? Well, it all has to do with something called the multiple on net asset value, or MNAV. For an investor to choose a company's stock rather than holding BTC directly, that company needs to have a positive MNAV, because that means that the company is outperforming Bitcoin itself and is at a premium. As such, this makes that company very attractive for investors and is extremely bullish for its stock price. MNAV might sound complicated, but it's actually pretty simple. Let's take Strategy for an example, which will remind you is holding almost 600,000 BTC. At today's prices, that's worth around $63 billion. However, the company itself has a market cap of $104 billion, which is 1.7 times the value of its Bitcoin holdings. As such, Strategy has an MNAV of 1.7x. Easy, right? Notably, though, the market will only award a company MNAV if investors believe that it could successfully grow its Bitcoin reserves in a reliable way. Historically, Strategy has had an MNAV of roughly 2x, which is now considered to be the gold standard for Bitcoin Treasury companies. Now, here's how this ties into the risks that these BTC Treasury companies pose to Bitcoin. Arguably, the biggest concern here is that while this accumulation has been good for our bags, it's also bad for Bitcoin's decentralization. Put simply, any entity with an abnormal amount of Bitcoin does present a risk, since they could potentially dump a whole lot at any moment, crashing Bitcoin's price in the process. This has sparked debate about whether it contradicts Bitcoin's core principles of openness, permissionless, censorship resistance, and of course, decentralization. However, it is important to highlight the fact that the Bitcoin blockchain doesn't restrict anyone from accumulating as much Bitcoin as they desire. Anyone can participate without restrictions. This means that although the ongoing stockpiling does potentially pose a threat to BTC, it doesn't violate Bitcoin's underlying decentralization. Broadly speaking, many investors are bullish about the number of companies that are adding Bitcoin to their balance sheets. Although, of course, there are some crypto OGs who are much less excited. And that's mainly because their business models are eerily similar to Grayscale's GBTC Trust, which for years was trading at a premium, much like the positive MNAVs that we mentioned earlier. This premium was considered to be bullish for Bitcoin, since it showed strong institutional demand, and also allowed investors to take advantage of arbitrage opportunities. However, GBTC's premium eventually flipped into a discount, at one point reaching 30%. This meant that sentiment had turned negative, sell pressure had increased, and those arbitrage trade opportunities reversed. Instead, GBTC investors were trapped in losses, having to sell shares for less than the value of the held Bitcoin. This caused a market contagion that resulted in more selling and more problems for Grayscale. And while not directly responsible, many see this as a key catalyst that contributed to the collapse of Terra Luna, Three Arrows Capital, Voyager, Celsius, BlockFi, and even FTX. But how does this relate to the Bitcoin Treasury companies? Well, just like investors were drawn to GBTC for its premium, many are attracted to the MNAV of these companies, which trade at an eye-watering premium. However, if the MNAV of these companies turns negative, the result could be dangerously similar to what happened when GBTC was at a discount. This is why many crypto OGs believe that this presents a systemic risk to the crypto industry, and are worried that history could repeat. One example is Castle Island Ventures' Nick Carter, who said, quote, "It's like writing a blog post in 2021 saying that we think the GBTC trade will last forever." Similarly, Blockworks co-founder Mike Ippolito said, quote, "This is leverage getting injected into the system. To spell out the risk, it's that these acquisition vehicles accumulate a lot of crypto at much worse terms than Sailor and eventually become forced sellers." At this point then, you're probably wondering just how much damage these worst case scenarios can inflict on Bitcoin's price. Obviously, no one could say for sure since that would depend on a variety of factors. The size of the failed company, how much BTC it holds, its capital structure, broader market sentiment, etc., etc. But safe to say, it obviously would not be pretty. The worst case scenario is probably a crypto treasury company death spiral. If the next bear market is deeper or longer than expected, companies like Strategy could see their MNAV premium turn negative just as large debts mature. Investors might then refuse to trade these stocks at a loss. Strategy could then be forced to liquidate its Bitcoin to meet its financial obligations, sending shockwaves through crypto. It would signal that even the most bullish are losing faith, sparking panic and driving BTC's price down even further, eroding Strategy's MNAV and refueling the death spiral. This would become a major black swan event. And what's more is that newer Bitcoin treasury companies pose a much higher risk. Unlike strategy, these lack size, regulation, and access to passive inflows via inclusion in major stock indices. As a result, many raise capital on tougher terms and accumulate Bitcoin with much higher leverage. And more leverage means more risk. And to make matters worse, smaller Bitcoin Treasury companies face a bigger risk of failing even sooner than expected. In early June, Standard Chartered predicted that if Bitcoin falls below $90,000, about half of these companies would be forced to liquidate. And we're not exactly miles above that price right now. However, this does assume that failing companies would simply collapse. More likely, smaller treasury firms would be acquired by larger ones, allowing for dramatic treasury growth by leveraging the failed company's desperation for a steep discount. But the reality is that even if these companies were saved in this way, the market would still panic and feel the FUD. And when we say the market, we mean the entire crypto market. Not only would Bitcoin's decline naturally drag down the rest of the market with it, but there have also been a number of companies creating crypto treasury reserves with altcoins. For instance, there's Sol Strategies, DeFi Development Corp, Upexi, and Crossover Holdings, all of which have focused on Solana treasuries. Similarly, SharpLink, BTCS, and Bitmine are creating Ethereum treasuries, while Vivo Power and Weebus International are focusing on XRP. There's also SRM Entertainment, which is creating a Tron treasury, and a new entity called Build and Build Corporation that's building a treasury made up of BNB. This activity is bullish for the altcoins being accumulated, but it does carry higher risk. These treasury companies are smaller, and altcoins themselves are inherently riskier due to their lower market caps, higher volatility, and reduced institutional demand compared to Bitcoin. So then, this all begs the question, what's next for crypto treasury companies? Well, in the short term, the answer is pretty obvious. For as long as Bitcoin continues to gain momentum on an institutional level and BTC's price moves up and to the right, companies will continue to accumulate more Bitcoin. This will naturally remain bullish for Bitcoin's price, encouraging more companies to follow suit. The catch is increased volatility. As more liquid Bitcoin is removed from circulation and stored in treasuries, the remaining supply becomes far more sensitive to price fluctuations. However, this could offer profit opportunities, but only for traders with the skills necessary to navigate these conditions. Most investors risk getting wrecked, fueling negative sentiment and driving BTC's price down further, which would create more problems for Bitcoin treasury companies. The caveat is that while it wouldn't be good news, a Bitcoin treasury company failing wouldn't be the end of the world, so long that it wasn't strategy that failed. That's because of all of the Bitcoin being held by publicly traded companies, strategy owns around 70%. The remaining 30% is split across another 140 companies. And in case you're wondering, it's highly unlikely strategy will need to sell any Bitcoin anytime soon. If you've been keeping up with our updates on the company, you'll know that 100% of Strategy's debt is now unencumbered, meaning that it's free from obligations. So, from our perspective, there's no immediate threat of liquidation. Meanwhile, we're likely to see more companies building altcoin treasuries, and that's simply because altcoins offer greater upside than Bitcoin, especially at this stage of the market cycle. But, as mentioned earlier, higher rewards come with higher risk, and this poses a threat to the broader crypto markets. Let's just hope that all these fears are overblown though, because our bags definitely depend on it. Okay, so if you enjoyed that video, smash those like and subscribe buttons to show it some love. And if you want to learn more about where we are in the current market cycle, just check out the video right over there. And if you want to see how much leverage can affect the crypto market, well, check out the video right there. Thank you all for watching. My name is Lewis, and I'll see you in the next one.